This conference will now be recorded.
I'd like to welcome along to evening 6 of the webinars for Management Accounting and Applied Finance. Coverage tonight will be units 7, 8 and 9, which are 3 of the 5 units you are going to see in your online assessment 3 in a fortnight's time. So basically as you walk into online assessment 3, it's 7, 8, 9, 10 and 11. So it's a costing area, it's a working capital management, but a little bit of a closeout to the analysing performance and also a look at pricing. So tonight I want to look at unit 7, which is our second of our analysing performance, unit 8 on pricing, and our unit 9 on our cost management, number 1 as they're referring to it. Certainly as we work through this, I will note that none of these units are getting huge examination at the moment. We're seeing components of each. We are seeing, for instance, as you look at unit 7, the return on investment being embedded into the larger analysis questions that we referenced to in unit 6, but you're not seeing too many standalone questions. Similarly, as you come across to unit 9, I should say, with respect to the life cycle costing and target costing and the like, every so often we're seeing a standalone 5 to 7 mark question, but even then it's every so often, so it's not a regular area of examination. So certainly they'd like to test it through the online assessment. It is a grouping of units, however, that I suspect will start to generate additional marks in an exam moving forward, and just looking to catch candidates who are only studying past exams. So if we focus on our unit 7 coverage initially, you've basically got the smaller of the analysing performance units, and in all honesty, guys, one of the smallest units in the whole coverage. It looks at return on investment and economic value added. Certainly they use the acronyms primarily, so once you get into the unit, you'll find that feel comfortable to write an answer as ROI or EVA and the like. But I'd also argue as you come down both paths, make sure you understand the questions are just as likely to be quantitative, so you doing calculations of return on investment or EVA, or qualitative. And from a qualitative perspective, it could well be you identifying strategies to improve, but I also would note that with respect to return on investment in particular, watch the dysfunctional behavior type question, where they tell you that you've got a return on investment of X percentage, and then they're looking at ways that management may try to achieve that return on investment that may not be best for the organisation in overall terms. So we'll see that as we proceed. Certainly from a past exam perspective, and straight away you can see as standalone questions, we're not seeing an awful lot. This 315 exam had a little A for 4 marks with respect to your logic of your return on investment, and then a little B for 2 marks with respect to your EVA type areas. So that was a combined question that had a look at both. The 313 exam, which again, if you can get your hands on this question, it is a very good EVA question, was a 6 mark question. But as that automatically illustrates, as we walk into an exam, no standalone question in this area since 315. Even if we do see it, we're probably not expecting to see much more than a 4 to 6 mark type range. From a return on investment perspective, however, I tend to suggest to candidates to break it down into 3. 1, understand that from a quantitative level, the Institute does make the point that there is no single standard formula for return on investment. So you'll find that you've got to watch the language and how they express it. So I'll build on that in a moment. They certainly expect that you understand the DuPont method of analysis, which is a means of adjusting your return on investment. But this is where I'm drawing on with respect to the behavioral implications. Activity 7.1 has you calculating, but also has you interpreting an explanation of where there is differences in performance, and you've basically got a reference to the DuPont method of analysis. And then just one other thing that catches my eye in this area is Candidate Study Guide, page 7-7. They start with a diagram, but then as you turn the page, they explain a whole series of limitations with return on investment. And I suppose I'm looking for that 2 mark question in the exam where you're explaining the weakness of return on investment, if you like. Now, you're going to have to make sure it's specific to the scenario presented. It could well be that you're picking up on the idea of it only measures historical performance, where everything else the organisation is doing is future orientated. that you may look at it from the perspective of that there's a target return on investment versus a cost of capital. You'll reject the project because it isn't meeting the target return on investment, but you should have accepted it because it is exceeding your cost of capital. This is where you come back to the behavioural implication type logic. So again, not necessarily something that I'm looking at going, yeah, you're going to get 10 marks on limitations, but more so one of these areas where I just make sure I can understand where to find guidance as I walk through. Let me come back to the start, however. Now, I've made the point that there's no single standard formula. What you'll find, however, is as you start looking at the Institute's material initially, they express it as operating income over investment. What I need you to understand, however, is as you then read down the page, note how they basically state, but for operating income, we're basically going to use the logic of our earnings or profit before interest and tax, and our investment will be total asset value. Now, this is where I'm just going to highlight with Management 315, that question that I identified. What was curious was that the Institute more so used the language of earnings before interest and tax and total asset value, and any number of candidates complained post the exam, how were we meant to be able to calculate return on investment if you didn't give us operating income or investment in the background facts? And the Institute's basic comment was, well, if you had engaged with the candidate study guide in any form, we did note that our primary wording would be the earnings before interest and tax over our total asset value. So again, it's just one of these areas where you've got to have an appreciation of the depth that you've got to be reading at. And in this sort of area, understand the different expectations with language. Certainly from a application perspective, if I was to give you something like that, we've got the brush division of Warren Limited, revenues of 400,000, variable expenses of 60, fixed expenses of 100, total division assets are 1.2 million. Warner has a minimum required rate of return of 12%, cost of capital of 10, and the tax rate 25. You've got to calculate the return on investment. Now, I have added additional details here, but that will be the case in the exam environment. They're likely to hit you with details that aren't needed. So we come back again. I've just noted that they've said that it's based on earnings before interest and tax. So I would throw the tax rate into the facts to see if you know that you don't need to worry about it. In actual fact, it should be a basic calculation. Revenue, take away your variable, take away your fixed, over your total divisional assets. So it would be your 240 on your 1.2, which gets you a return on investment of 20%. So as a start point, we have a base appreciation of where we're looking for a response from. As we then look to build that, however, we then appreciate that once we can do the calc and understand how it is determined, we do need to understand the DuPont method of analysis. Now, this is basically actions that can be taken to improve your return on investment. And as would be expected, if there's a numerator and denominator, you'd look at increasing your total gross profit. You'd look at reducing your level of investment. So generically, in terms of increasing your total gross profit, you would increase revenue or you would look to decrease costs. In terms of your reducing your level of investment, you would look to decrease your total assets. Now, one observation I'll make here, however, if you were to really dig into the coverage with respect to DuPont, you'll find DuPont actually talks about there being 3 scenarios. And he talks about the fact that for option 1, you would increase your revenue, hold your cost and investment constant. Number 2, hold your revenue and investment, decrease your costs. Number 3, hold your revenue and your costs, and you decrease your investment. So this is where I'm then going to highlight that if you're looking at this from a behavioral analysis perspective, so what are they doing that's dysfunctional? Can you please pay attention in particular to where they've reduced costs or reduced investment that may not be in the best interest of the organisation? So one you'll commonly see is where they talk about they've reduced staff training. Well, if you reduce staff training, 1, you may have staff in the future that have limited skill sets. 2, you may disenfranchise staff, which creates employee turnover. So whilst you've reduced costs that have allowed you to improve your ROI, it is dysfunctional for the organisation. So again, just a couple of base points. The other side to this unit, however, is the economic value added. Now, what I will note here is, again, from a quantitative level, it is developed by Stern Stewart. You will find in turn, guys, that if you were to engage with the coverage by Stern Stewart, they've written a text called Quest for Value, which goes for about 300 pages. Now, you don't need to pay any attention to that document, but what you do need to understand is that if you try to do any additional research on EVA, understand that the formula that the Institute is looking at is basically Stern Stewart's endpoint. And what I mean by that is that they start with a very detailed formula, and then as they break that formula down, the formula you are seeing is the formula that they arrive at the end of the process. So we need to understand the base logic, if you like. We also need to understand, however, that it does include your weighted average cost of capital, which you see in Unit 12. So do not be surprised if you walk into a question where it starts with little a, you calculating your weighted average cost of capital. And then as you come to little b, it goes assuming a weighted average cost of capital of X, that you then do your EVA calculation. I would also note, however, if you read closely the Institute's material, they do highlight that when you're calculating EVA, you do not need to apply accounting standards in arriving at your assets and liabilities. So you can just apply management accounting logic. You don't need to apply financial reporting logic. But you'll also find that as you engage with activity 7.2, it does have a calculation element to it. But what I actually quite like is they look at it from the point of view of the appropriateness of the measure. So you working your way through and identifying whether EVA is an appropriate measure as a first step. So again, the calculation is very important, but I do like candidates in this area in particular to understand the extension type areas. Now, one of those extension type areas is your strategies to improve. Now, you'll find that, again, they've presented you 3 strategies in the Institute's material. I'm going to request, however, that you specifically apply them, because you'll find in Management 313 that the Institute did comment that some candidates were generic in applying the strategies. So let me step that across 2 points. Formula-wise, it's EVA is your net profit after tax. So straight away note how it is an after tax. Your return on investment was before tax. So therefore, you've got to ensure that as you move from one calculation to the other, you're watching, have they given me a tax rate? Again, you take your weighted average cost of capital, which I would suspect that they will give you, but there's always a part chance that you will have to calculate based on Unit 12. And you multiply that by your total assets less your current liabilities. Now, the first observations you are going to take, it is that your current liabilities only. It's not your total liabilities, current liabilities only. You'll also find, however, should you be in the exam and see any reference to what we refer to as a capital charge, understand that the logic of your weighted average cost of capital by your total assets less current liabilities is the capital charge. So that's the alternate phrasing that I've seen the Institute use, and candidates have gone, well, you haven't given me the detail to answer. How am I supposed to know what the capital charge is? Well, it's that component of the formula. If we were to apply that, however, we've got Ambrose, New Zealand resident company. So one thing I would expect in this area, do not be surprised if they swap you from being an Australian company to a New Zealand company. From a tax rate perspective, however, they are going to have to give it to you. So they will not expect you to understand the alternate tax rates. But note how I start you off at net profit before tax. I've then given you your current assets, non-current, current liabilities, non-current liabilities as they have in past exams. Given you the cost of capital at 10%, tax rate of 25%, calculate your EVA. Well, to calculate the EVA, I take my 1 million by my 1 minus my 0.25. Keep in mind, I've got to make it a profit after tax figure. My WACC, my cost of capital, is 10%. I've then got to take my total assets. So note, I'm taking both my current and my non-current. This is why they'll give it to you in this form. And then they'll see if you know to take that and then take away your current liabilities. If I do that, I come to a positive EVA of 300,000, which means that value is being added to the organisation. A negative EVA means that you're reducing the value of the organisation in total. If you're then looking at it from a strategy perspective, however, you'll find the Institute makes the point that your EVA strategies from a profit perspective include increasing revenue or reducing your expenditure. From a capital related perspective, you're looking to use fewer assets to generate the same revenue. You're looking to invest in higher return activities, or you're looking at disposing of underperforming assets, or alternatively, you could do a combination of those. Now, you might remember that I've already referenced to the fact that with your prior management exam, I suggested for Management 313 that candidates were generic. So to understand the logic here, guys, appreciate that in that instance, they had given you the fact that there were stores, so retail stores, that were underperforming. So therefore, candidates seem to understand, well, if you sold the stores, got rid of the stores, that would improve your EVA. What I need you to appreciate, and note how pedantic the Institute can be, any candidate that said dispose of underperforming assets was marked incorrect from my understanding. Any candidate that wrote dispose of underperforming stores was marked correct. So the change of one word from assets to stores made it specific to this scenario and earned you the mark. And again, we come back to the idea that with management, it is in part this understanding of what the Institute are pedantic about at times. The other observation I'll make as we look to close out Unit 7, however, please note they do a little bit of coverage, especially through Activity 7.3 and through the Candidate Study Guide starting on page 713. They do look at contrasting return on investment to EVA. They've got a table presented where they talk about complexity of calculation through to comparability across organisations, the ability to link it to shareholder expectations. They do make the point with respect to complexity. Return on investment is seen to have a low level of complexity. You'll find that your EVA is seen to have a medium to high level of complexity. Contrast that to as you come through to managerial understanding, they talk about return on investment has a medium to high understanding by managers. EVA has a low to medium. Now, I could keep doing that for the whole process, but all I'm trying to bring to your attention is that if you're sitting in an exam and you're having to give a reason why in this instance it would be better to use EVA or better to use ROI, that table in the Candidate Study Guide on page 713 may be an appropriate path to follow. But as I said, one of the smaller units you are coming across. As we then jump from there to Unit 8, Unit 8 you are looking at your pricing coverage, and again, I will highlight not a lot of direct examination of Unit 8 of late. I break Unit 8 down into 5 areas: evaluating qualitative and quantitative factors, your pricing models, your discounting, your target sales price, and your yield-based pricing. But even then, I'm also tend to carry the target sales price coverage across to Unit 9 to when we see our coverage with respect to our target costing. And I tend to suggest that they are linked, so therefore we will look at it under the target costing logic this evening. As for the other areas, certainly for you evaluating qualitative and quantitative, if we look at it from a qualitative perspective initially, what I'm going to address is that the Institute makes the point that if you're going to establish the price of a product, you would start off by first considering the 3 C's. So Candidate Study Guide, page 8-3. You would look at what the customer is willing to bear, what your competitors are charging, what the costs being incurred are. So naturally enough, you've got to make sure you're covering your costs. You've also got to be relevant to what competitors are charging and ensuring that if you want to be seen as a dearer or cheaper product, but you also need to be mindful of what customers are going to pay. So that's where you might have to come back to the idea of understanding, well, how much do I think a customer will pay for this? I need to produce a product to that level, if you like. The Institute does then run through a whole series of other areas. From a strategy perspective, for instance, they'd expect you to be able to look at it from a differentiation to cost leadership. So if you're differentiating, go back into your Unit 1. They'd expect you to understand that you're a premium product, so therefore you should have a premium price. If your strategy is one of low cost or cost leadership, you should be one of the cheaper products on the market. They talk about, are there any regulations around the prices that you can put in play? They look at the concept of customer psychology. So this is that logic of we'll sell something for $99 because it's less than 100 and looks more attractive. Now, again, guys, I would highlight that is part of your customer psychology. I would also suggest today, however, if I'm walking through somewhere like a Coles or a Woolworths, what seems to catch my eye is that, yes, there's still that idea of your 99 cents type logic in play, but there's also a greater emphasis today than what there has been previously on that bulk buy type logic. Buy 2 for $5 as opposed to 1 for $3 type process. You've got your supply constraint area. So again, the base logic is that if you have excess capacity, you might reduce your price. If you've got limited capacity, you would increase your price. And then from a time horizon perspective, it's basically looking at it, are you developing prices for the short term or are you developing prices for the long term? So again, if we were to give consideration to if you're, developing a price to the long term, you've basically got to be mindful. So I'll take my instance. If I'm looking at establishing prices, I don't like to change prices often because I must admit, if I was a client using CA Study Assistance resources, I don't know that I'd want to go back every 6 months and find the price has changed, especially if I'm doing it from a firm perspective. So I try to go through a 2-year type rotation, which is basically a little bit longer than what I trust candidates are taking to get through the CA. The idea being, and yes, some do get caught by it, the idea being, but if I set a price today, I've got to be mindful of where I think costs are going to be in 2 years' time in terms of trying to ensure that I get one, appropriate profitability across that time frame, but also trying to ensure that I'm mindful of where I think customers might head in terms of what they're willing to pay. So that would be that long-term type environment. I'd also note, however, from a quantitative level, pick up on your price change logic. But just before we get to that, even if I was to give you something as simple as Xerox Bikes manufactures bicycles, the Celtic is a new bicycle that is about to be released on the market, and management have asked you to consider the factors that would be considered in setting the price. Now, in this instance, and again, if I try to keep it simple, I would like to think if you're looking at the Institute's material, you can automatically go, well, I'd talk about cost, I'd talk about customer, I'd talk about competitor. Now, if you're looking at that and going, but seriously, Graham, that seems very simple. That's the point. Guys, if I've got one issue with candidates historically, is that they don't want to take the simple marks from the Institute. They tend to try to overly complicate it. So they've given you a new bike. They've told you what factors you would consider. So 1, what are your costs? 2, what do you think the customer will pay? 3, does the competitor have something equivalent? From there, you might also give thought to, well, what is your strategy for this bike? Are you wanting to be seen as a differentiation? Are you wanting to be seen as low cost? You might also need to give consideration, however, as to where does the product fit within your range. Again, we're saying they manufacture bicycles and this is a new bicycle. So where does it fit in the range? Is it mid-range? Is it the lower end? Is it the higher end? So they would be just an example of some of the factors. What I was going to suggest, however, is that as you build through, you will find there is a formula presented in the Institute's material. So Candidate Study Guide, page 8-6. They have presented a formula which relates to if you change the price, what is the percentage change in sales volume that you are willing to accommodate for that price change? And basically it's the logic that if you change price, you're likely to change the volume of sales. If you decrease your price, you'd like your volume to go up. If you decrease the price, if you increase your price, you would expect your volume to decrease. So what you're looking at here is to try to come up with a percentage change in sales volume that allows you to interpret, has it been successful? Now, what I'm just going to note initially is that if you were to increase your price, make sure you understand that the new gross profit, so this new gross profit is basically the original gross profit plus the price increase. So don't overcomplicate this. Don't go back and reconstruct a whole series of numbers. If you're talking about a price decrease, your new gross profit is the original gross profit less your price decrease. So again, we keep it simple as we engage. I would also note, however, that as you work your way through this, note if I do get a price increase, then I should get a negative percentage, which represents the sales decrease that I would expect to incur. So if I get a profit increase, I would expect that will give me a negative percentage that represents the sales decrease that I can bear for that price increase. Note, however, if that sales decrease is greater than the percentage calculated, then my profit in that instance would decrease. So this is where you've just got to make sure. Great that you can do the calc, but you've got to be able to apply. If my price was to decrease, that should give me a positive percentage, being my sales increase. Now, this is the sales increase that I would need to achieve. So you'll find the way you interpret this is if your sales increase is less than the percentage calculated, then your profit will in turn decrease. So we just need to ensure that we're comfortable with the idea that if our sales increase less than the percentage calculated, then our profit will decrease. And I will remake the point. If you're looking at even an analysis question, this may be something just to give some thought to if they represent it in the facts. Have they given me a change in sales volume? Have they given me a percentage? And I should be able to make a determination of whether that has been met to give me my profit increase or my profit decrease. From an example perspective, I've got Xerox Bikes manufacturing bicycles. The Ninja is a new product proving more popular than expected, and management are keen to maximize their gross profit through increasing the price by 15%. Currently, the Ninja is sold for $300 and generates a gross profit of $90. Should the price be increased, there'll be no change in cost experience. Now, that is the underlying assumption of this formula. Guys, this formula only holds if we make that assumption. So you'll find that embedded into the Sum of the Institute's wording. You've got to calculate the reduction in sales that could be tolerated, but which would ensure the current profitability is maintained. So note, we currently generate a profit of 90. We're doing an increase in price by 15. The current price is 300. So my new gross profit would be the 90 plus the 300 by the 15%. That's my price increase, which gets me to 135. My 90 less my 135 on 135 gets me negative 33.33%. Therefore, again, if my sales decrease by greater than that percentage, then my profit will decrease. So that is how I would need to read that process. That's how I'd need to read that coverage. As we then build that, however, we then come through to the fact that once we understand the base, we move to the logic of our pricing models. Now, you'll find for the pricing models that there is a cost-based, demand-based, and other logic. You'll find that the cost-based has been examined in 313 and 113. And this is what I mean, guys. We haven't seen a lot of standalone questions in this area of late. There's several models that I'll show you in a moment. I'd also note, however, that with the demand-based, this is where they talk about customer segmentation. And in worked example 8.1, I think this is the one from memory that is the child minding service. And that they talk about you have different prices in play at different times of the day. So after school, I think was dearer than during school hours. What I might also note, however, is as you start looking at that question, can you please note how it starts with a look at the information needed to determine your prices. So that constant theme that I keep talking about, where they are consistently getting you to consider, well, what information would be needed? And I just keep reinforcing that point. From an other perspective, we'll move to value chain and life cycle in a moment. Let's just come back to the cost-based initially, however. Understand that there are several cost bases, and the idea being that you would determine either full cost, variable cost, your activity-based cost, your target return on investment. So you basically select one of these you take that cost and add a markup to it. So that's where you'll find in activity 8.1. I think it is task 2 from memory, where they do variable cost plus the markup. Task 3, I think, was a full cost plus the markup type logic. So having you understand a process that would be employed. Now, naturally enough, the key to this is you being able to distinguish your variable costs to your fixed costs. And that is, curiously, if we go back over the years where candidates have gotten into trouble in the exam environment, not understanding what a variable cost and what a fixed cost is. So variable costs change with level of production. Your fixed costs do not. Your full cost, naturally enough, has both variable and fixed. Your variable cost only has variable, naturally enough. Now, we'll come back and we'll consider activity-based costing as we go, but you will note through there that we are adding a markup. Please make sure you understand that with the Institute's material, markup is correctly presented as your selling price less your cost of sales over your cost of sales. That could also be shown as your cost of goods sold. So a couple of different ways that formula can be presented. Your margin is your selling price less your cost of sales over your selling price. So they do give a representation here of how you go about determining your markup. Now, if I was to apply that simplistically, I've got step ladder limited manufacturers ladders used in the construction industry. Variable manufacturing costs are $20. Fixed manufacturing costs are $25. You have variable selling and administration costs of $42. You have fixed selling and administration costs of $20. Prices based on variable manufacturing costs plus a 200% markup. Calculate the price of the ladders. Now, the key here is note you've used variable manufacturing costs. So our only variable manufacturing cost is $20. So I've picked up the 20. I've then picked up my markup of 200%, 20 plus 20 by the 200%, which kicks me out a figure at 60. Now, the only problem with that, however, is that I've applied an inappropriate pricing methodology, because if I was to work out all these prices, you'd actually find that tags out at 107. So the fact that I have utilized a methodology which has kicked out a price of 60 means that I haven't actually achieved my base costs, so therefore I would be making a loss on per unit. Now, again, if you're looking at that and going, well, what's the relevance? Surely they're not going to be that simplistic. This is where I come back to your analysis style question. They may tell you the pricing methodology that is employed. They may ask you to explain the performance. One of the ways that you may be able to explain the losses that they're making is by referencing to the fact that they are using a pricing methodology, a pricing model that is creating that loss. So we understand the different directions they can come from. I also mentioned how they could look at your logic of your life cycle pricing and through. Now, what you're looking at your life cycle pricing is this is just at different stages of your life cycle that you'll have different thought process. So introduction phase, the Institute looks at the idea of price skimming and price penetration. So price skimming, you go a higher price upon introduction. So think your iPhones, think your gaming systems. They always tend to release gaming systems at a higher price. They're looking for those that want that experience. They then slowly reduce those prices over time. Price penetration is where you do a low initial price for a new product. You're trying to get some traction in the market. So I think the Institute uses the example of an airline with a new route to try to get people to take those flights. Now, I will just note, as you engage with both of these, understand that one of the limitations they make with the price penetration is that it can be interpreted by the market that that's what you see the value of the product as. So then in a month's time, 2 months' time, 3 months, when you go to increase the price, why are you increasing the price? You haven't changed the service, and that can create disengagement from customers. So again, just understand their logic in play. But if I'm going to talk about logic, I'd also come across to your decline phase. Now, what I want you to think about is as you're looking at this, if I was to give you at the decline phase, what are you going to do with your price? Is your price going to increase? Is your price going to decrease? And I have absolutely no doubt that some of you are sitting there tonight going, Well, typically I would have thought price would decrease because you'd be trying to keep still selling product. So therefore you keep declining the price to meet that requirement. And again, no real issue with that logic. What I do need you to observe, however, is in the candidate study guide, page 814, the Institute does make the observation that it is possible, so note their language, that it is possible that the price may increase. Now, they don't say it will increase. They say it is possible, and they put it on the back of the fact that there may be a reduced number of customers for your product who are loyal for your product and who demand your product. So therefore, they're still willing to pay a higher price so they can get that product. So all I'm trying to bring to your attention is that if we engage with Institute logic, if I had background facts where they told me that there were loyal customers who are still demanding my product, and if they asked me something around pricing, I would have to talk about a price increase if I'm going to apply their logic. As we then look to expand from there, however, we then come through to our logic with respect to our discounting. Now, as you consider your discounting type area, understand the role of discounting is naturally enough to generate demand, so to increase your demand, that's fairly obvious. But then what I will observe is that the Institute does work through those instances when discounting is seen to be effective. They do talk about issues that can arise from discounting, including impacting on your profit margins, public perception, staffing. So they make the point, if you discount and it proves extremely successful, are you going to have the resources on hand to meet those requirements? They then also do a little bit of a look at your pricing waterfall logic. Now, as we build, I just want to build on the effective and the pricing waterfall. Certainly from an effective perspective, I will highlight that the Institute states that there are 4 instances when you might expect to see discounting being effective. So when you're looking to move perishable stock, move stock close to being superseded, utilizing excess capacity, reduce inventory to boost cash flow through and through. What I would just ask, however, in this area, again, make sure you are specific. I've seen this back many years ago. They asked candidates a reason why they might have been looking to discount price. Any number of candidates went with moving perishable stock. The only problem was if you had close read to the background facts, the stock was not perishable. So another one of these instances where the Institute basically told markers, if they start with move perishable stock, and then if their second one is moving stock close to being superseded, you are to interpret it as a textbook answer, not an answer where they've thought it through against the facts. So we need to just, again, appreciate expectations. We then come through to the logic of our calculating our impact. What I'll just highlight on this one is that if you are going to decrease your price, so you're going to discount, you should get a sales volume increase. What you'll find, however, guys, that is exactly the same formula. So exactly the same formula that I gave you earlier. So that's where they could bring this into play, give you a discount scenario and see if you can apply that logic. So similarly, I've got my Xerox bikes. The Raptor is one of their older products and management are keen to clear a build-up of inventory. Currently, the Raptor is sold for $150 and generates a gross profit of $40. Should the price be decreased, there'll be no change in costs experienced. Calculate the increase in sales that would need to be achieved if the price was discounted to $135 to ensure the current profitability is maintained. Now, what I'll just bring to your attention in this instance is note we're reducing from $150 to $135, current profit of $40. So if I use that formula again, current profit of $40, take away my price decrease, I come to $25. $40 less my $25 on my $25 gets me my sales volume would have to increase by 60% to still achieve the same profitability. Should I not achieve 60%, should I achieve 40, I'll be reducing my overall profitability. So we can just see how something that's shown to us earlier in the unit can be shown later. But then I'd also note on that point that whilst I can talk discounting generically, please note they do represent a concept of the pricing waterfall. And this is just the different forms of discounting. So your order size discount, your early payment discount, your annual volume rebates and through, just an area that I would suggest that as I'm sitting in an exam, I understand they may just not go, oh, you're discounting price. They may talk about you doing cooperative advertising, which is where you have payment for advertising in a catalogue of a seller of your product. Again, that is you providing a discounted price to the actual party that is selling your product because you're partly meeting costs for them. So there's that offset type logic. So just keep yourself open to that alternate terminology. Similarly, if I'm going to talk alternate terminology, just make sure you're comfortable with respect to yield-based pricing. This is where you'll have variable pricing aimed at maximizing profits, typically used by airlines, typically used by hotels. So again, come back to that idea that if you're looking at, so I was looking at today, flights from Sydney to Melbourne, you'll find that throughout the day, the prices vary based on the fact of how much utilization of that resource do they already have. Do they have seats available and they're trying to fill them? Do they have limited seats available? So you'll find for yield-based pricing to be applied, fixed amount of resource available. So on an airline environment, there's only so many seats on a flight. Resources perishable. Well, once the flight has gone, you can't sell those seats anymore. And customers are willing to pay different prices. Well, again, that comes down to the situation that you're in. And do you need a seat on a particular time flight or not? And you may be willing to pay alternate prices. But again, as I said at the start, Unit 8, you see a little bit with respect to your yield-based pricing and your pricing in total. We haven't seen a lot of direct examination, so good engagement with the base logic is my suggestion. But I could argue the same with Unit 9. Unit 9 is your cost management number 1 area. So next week, we'll look at our activity-based costing type area. And guys, you'll find that there are 3 concepts in here. They have life cycle costing, where I'd suggest you understand its application, the benefits, understand the phases, and be able to do your calculations. You've got your target costing, so I'd understand the stages or steps involved, the phrasing of a question, and the ability to do calculations. And then your cost volume profit area, which is where you need to understand the base assumptions, but be able to do single product and multi-product. So if I was just to build across these over the course of the next 15 minutes. Life cycle costing, basically it's a method of managing costs over the whole of the product life. Now, what I'll just highlight here, what this is trying to combat is what we refer to as looking at products on a period basis. So we've looked at the costs that have been incurred over the last 12 months. We make a decision as to whether we're running with that product into the future based on where our costs over the last 12 months are versus what our profits are. Now, what you'll find is that with respect to life cycle costing, it is argued that the benefits include that all costs become visible. It allows analysis of business functions into relationships with things such as research and development. It allows differences in early stage expenditure to be highlighted. Because this is very much about the fact that if you think about research and development, it is generally in the first instance expensed and therefore not taken into account once you're actually looking to sell a product. You're looking at, well, what costs are we incurring now? The whole idea behind life cycle costing is to get recoupment of your research and development, which is where we talk about the 3 phases. So your pre-production would be your R&D, might also include your marketing type logic. You've then got your production and your post-production. So as I build this through, note with respect to your life cycle calculations, the Institute seems to have an expectation that you can engage with the format that they have presented in Activity 9.1 and Worked Example 9.1, both comprehensive by the fact that you are comparing 2 alternatives. So there's 2 alternative scenarios. You're doing calculations, seeing which one across the time frame gives you the better outcome. Guys, understand this 317 question was a 5-mark question. You were not doing 2 alternatives. So that's where I'm going to argue. They are very comprehensive, very good learning, but understand you're not going to do something that calculation based in an exam. It'll be something more like what they do in the online assessments, more like they did in 317, where it was basically here is a 3 to 4 year period, and you've got to work out what your life cycle position is at the end of that 3 or 4 year period. Note in turn that 315, that was a 2-mark theory question. What benefit would they have gained from employing life cycle? Now, I'm going to show you that report in a moment, however. I will also note that they do reference to the concept of a lifetime return on investment. Make sure you understand your lifetime return on investment is your cumulative profit divided through by your investment. So as we look to draw those points together, I've already referenced to the fact that there is a standard format. And what you'll find with this standard format is that you've got your phase 1, phase 2, phase 3. So this could be, for instance, June 18, June 19, June 20, June 21, so on and so forth across. You'll find that your pre-production will come into your phase 1. You'll find that your phase 2 will typically be the range across your sales revenue through to your warranty. Naturally enough, you'll also find that as you come to phase 3, this will be your washout phase. The primary one you see in there is your warranty type area. So even if I was to go loosely, you might find -10, -15, +5, +20, +10 and through. Well, if I'm looking at this from a cumulative profit, -10, -25, -20, back to 0, +10 and through. So again, just an appreciation of how you develop this. If I was to illustrate it probably at the depth of your online assessment that you're going to see, we start off with Northfield, reviewing the application of life cycle costing to its product range. Expenditure already committed for the design and development for the year ended 30 June 2018, 450,000, 30 June 2019, 1.2 million. Estimated sales quantities are 40,000 units per annum for a 3-year period beginning on 1 July 2019. Expectations are based on pricing and costing of 150 for selling, 50 for manufacturing, selling and distribution 40, and your average warranty cost expected to run 6 months after. Now, this is what I want to show you in particular. As we look to construct that, however, the 450 and the 1.2 is pulled from the facts. Note the figure of the 6 million would be your 40,000 by your 150. So that's your 40 by your 150. Your manufacturing would be your 40 by your 50. Coming through with respect to something like your selling and distribution and your warranty and through, that would be your 40 by your 40. But then the one I want to highlight is note how with respect to the warranty, I've got some in the stage 2 or phase 2 and some in phase 3. This is this 6-month lag logic. So for this figure, I've gone 40 by 20, but in the first year, I've divided that through by 2 to represent my 400,000. Come through to my phase 3, that's when the 6 months washes out. But you'll note how I go from a cumulative profit of -450 through to a positive profit of 3,150. Now, that is probably borderline for the actual exam. Certainly, as I said, 315 had a small variation on that. I would highlight, guys, that understand for the online assessment, we have seen something of that sort of size historically. So I'd just make sure I've engaged with that process. If I'm then looking at doing my lifetime return on investment, I take my 3,150 and note, guys, that you use your cumulative figure with respect to your phase 1. So it'd be your 3,150 on your 1,650 in this instance would get me my lifetime return on investment. You'll also find how then as you build in this unit, you come across the target costing concept. Now, I would make sure I can link this back to my cost leadership generic strategy. What is one way that you could achieve your generic strategy of cost leadership? Employ target costing. You'll link it back to your target sales price, but this is in part based on where this logic has come from. Basically, my understanding is that the Japanese came up with target costing when they were looking to get motor vehicles into the US. They decided what price they were going to sell at, They decided what profit margin they wanted, which is where this language of the deductive subtraction method comes from. They then determined the quality that they wanted. They then basically sent it off to R&D and said, here's the cost, this is the quality or level of detail. You've got to research and develop a vehicle to that. R&D brought them a vehicle, said we can't do it, here's the best we can do. Apparently it got shipped back to them and said, no, this is the level of cost that you've got. So make sure as you work your way through, activity 9.2 does target costing for a special order, but you'll find that in both the 315 and 115. So straight away, note how with the logic coming through of target costing, life cycle costing hasn't really been seen since 2015. So that's where I'm suggesting I would expect that at some stage it'll draw back into an exam environment. But you'll also find that if I look at that logic, I can apply it simply. And this is the sort of thing you'll get in the online assessment, where we've got Morris Motorcycles manufacturing motorbikes. They have a target wholesale price for their GLX 950 is 4,320. They desire a margin of 40%. The only other information you have been provided with is that fixed cost per unit total 800. Calculate the target variable cost. Now, first observation, note how I've given you margin, not markup. So you know margin is your price less your costs over your price. So therefore your margin given as 40% would equal your 4,320 less your target cost over your 4,320, coming through to a target cost of 2,592. Picking up on the fact that I've also got fixed costs of 800 and that you've been asked for a target variable cost, 2,592 less your 800 gets you your target variable cost of your 1,792. And that would be the level, the layering that I would give consideration to in terms of deriving that figure. So again, just an appreciation of how you would do that sort of calculation for the online assessment. The other area you've got is your cost volume profit analysis. Make sure you understand that as you engage with the institute material, they go through a whole series of assumptions. So costs can be identified as variable and fixed, revenue and costs are linear, so on and so forth. I would argue through here that you could see a single product or a multi-product. Both are likely to have quantitative analysis. With the single product, I might just understand the factors to consider. For the multi-product, I'd have to understand the logic of my sales mix. So if I focus on a single product, I'm going to argue questions could be done at either break-even point or target profit. You'll find that in actual fact that as you engage with activity 9.3 and worked example 9.2, your activity 9.3 is a base calculation. But first observation, note how it is a base calculation related to delegates at a conference. So I would argue if I walk candidates into an exam with a cost volume profit, most would be expecting to be in a scenario of manufacturing. Note the activity shows you in a non-manufacturing environment. Worked example 9.2 in turn is a very detailed calculation question in this area. The last time we've really seen it was back in 214. So even here, guys, you're probably going back that 4 to 5 years since you've seen a decent question. Now, the factors that you would consider are, as you answer a question, have they asked you to answer in unit or dollars? Are there any constraints? And what are the GST implications? Well, the base GST implications are that you must have both your price and costs exclusive. So these are determined exclusive of GST. But as I said, from a formula perspective, understand your break-even point is your fixed costs over your selling price less your variable cost. Noting that selling price less variable costs is also seen as your contribution margin per unit. So that's one way they may word it. Here's your contribution margin. So you just take your fixed cost divided through. If they ask it a target profit, take your fixed cost plus your target profit over your contribution margin. If it's a target profit after tax, then you divide your target profit through by 1 minus the tax rate, and it would be your selling price per unit less your variable cost per unit. If I was to use a simple example, I've got my Step Ladder Limited, manufactures ladders used in the construction industry. Fixed cost per year are estimated at 3 million. At production of 50,000 ladders, total costs are 5.1 million, whereas at 100,000 ladders, total costs are 7.2. Variable cost per unit are constant at all levels of production, and ladders sell for $100 each. calculate the break-even point in units. So first of all, note how I've given you the fixed cost figure. What I haven't given you, however, is the actual variable cost. So note, as you walk into these questions, don't expect all the numbers to be clean. You've actually used that information there to calculate your variable costs. So the movement from your 7.2 to your 5.1 over your movement in 50,000 units gets you a variable cost per unit of 42. Gets me a break even of 51,724.14. Therefore, 51,725. You must round up these calculations to generate the mark. If you leave your answer at 0.14, you are going to be marked wrong. You must take it up to the next round number. You'll also find, however, if I use that same set of facts, but now add in that I want a profit before tax of 80,000, but note in turn that I want a monthly profit of 80,000, I then need to turn my fixed costs into a monthly figure, 250 plus the 80 over the 58 gets me 5689. Therefore, my answer is 5690. So even on those two simple examples, note how you still had to do a little bit of legwork to find the numbers that you're wanting to utilize. As you then build, however, you then come to your multi-product scenario. Now, from a multi-product scenario, you're going to have to pick up on the logic of your sales mix, or what they refer to as the standard batch. You pick up your contribution margin for the individual product, your contribution margin for the standard batch. You've got to make sure that you extend your final answer across to your sales mix that has been determined. So again, if I explain that a little bit more, you'll find that in this sort of area that you've got to come up with your number of products, 2, 3, 4, how many they've given you. You pick up your contribution margin per unit. So that's your selling price less your variable cost. You're then going to have to use a standard batch. So the standard batch can either be done as a percentage, a decimal, a 1 to 2 type relationship. So that could be, for instance, for every 2 of product 1, I sell 1 of product 2 and 3 of product 3. You then multiply those figures through, and then you add down to arrive at your contribution margin per standard batch. Divide your fixed costs through by that contribution margin per standard batch, get you a break even per standard batch. So if I was to illustrate that process, I've got Holt provide you with following information regarding 3 products. And again, a reasonably simplistic formula, but I've got units sold per month of 80, 120. My selling price at 50, 64, and 84. Variable cost per unit, 48, 61, and 77. Contribution margin of 2, 3, and 7. Holter's annual fixed costs of 4, 8. Calculate your monthly break even. Well, in that instance, if I'm calculating a monthly break even for each product, what I need to do is to be able to work my way through the actual standard batch logic. So I would actually construct as my contribution margin per unit is my 2, 3, and 7. So there, that's that row of numbers. Note I've then taken my relationship. So I sell 20 of Z. So 20 divides into 80 and 100 by 4 and 5. So therefore it would be 2 by the 4 would get me my 8. My 3 by my 5 would get me my 15. My 7 by my 1 would get me my 7. 8, 15, and 7 gets me 30. My break even per standard batch is therefore I take my fixed costs of 400, picking up on the fact that, again, constraint-wise, monthly break even, that's an annual figure. So divide that through by 12, gets me 13,334 rounded. But if I leave my answer there, I actually haven't answered it because I've told you the number of standard batches you need to sell, not the number of units that you need to sell of each. So what you then do is multiply that back through by your standard batch. So in actual fact, to break even, you need to sell 53,000 of product X, you need to sell 66,000 of product Y, you need to sell 13,000 odd of product Z, and that would give you your total number of units that you need to sell to break even. And I would admit, again, that's not the most complicated formula or representation of facts that I could give you, but provided you understand the base construct, it's just then you being able to identify the numbers that you need to utilize. So I trust this evening that's given you a little bit more of thought about how you've got to be thinking about your units 7, 8, and 9. I'm going to call the session at that point in time. We are going to get together again next Tuesday night, so we revert back to the Tuesday night next week, and we'll be looking at 10, 11, and 12. Guys, I do have to include part of 12. I appreciate it's not in your third online assessment, but considering we've only got one session after that, I don't want to be trying to do 12 through to 15 all in the one evening. So I will just accommodate part of next week to get Unit 12 looked at as well. But I'll call the session there. If you've got questions, please feel free to stay on and ask. Otherwise, guys, we'll catch up in a week's time. Thanks, everyone. Thanks, Brendan. I'll call it there. Thanks all. Thanks, RJ.